Welcome, everyone. Thank you for joining us for today's Barron Emerging Markets Fund, International Growth Fund, and New Asia Fund webinar with portfolio managers Michael Kass and Anuj Aggarwal. My name is Roger Mack. I'm a director on the National Accounts team at Barron. Before we get started, I want to encourage you to submit questions at any time during this webcast by typing them into the question box in your Zoom control panel. With that, let's get started. Thanks for joining us today, Michael and Anuj. The first quarter got off to a strong start, particularly for EM and international equities, then turned pretty volatile and the strength faded. In your perception, what happened there?
Sure, thanks, Roger. Well, yeah, it was definitely a volatile quarter. I guess everything ended fairly well, but there were twists and turns in expectations, sentiment, market leadership. Several of them during the quarter. I mean, as you said, January began much as 2022 ended. Global expectations were easing. There was downward pressure on bond yields and the dollar. And the recovery in global equities was gathering pace as we moved through January. And that was really led by EM, China, and international equities. They were all outperforming. Then, by early February, we started to see a series of stubborn wage and inflation readings, concentrated in the US, but some global. And that began to trigger a notable reversal. It was a return to fear of the Fed. Bond yields and central bank rate hike expectations spiked higher. The US two-year Treasury note, the yield moved above 5% for the first time in 15 years. And with this, the dollar rose, equities retreated, and EM and international reversed those relative gains that they had in January. And then, of course, March 9th, everything changed again. I would say that the abrupt spike in rates that was playing out through February started breaking things again by early March. And what I mean by that is if you look back to late September, we had the UK pension crisis. This time it was pressure in the bank sector centered in the US, in particular SVB Financial Group's liquidity and solvency challenges. And here, the concern over deposit flight quickly spread, not just across US regional banks, but more globally, and kind of certainly it compromised the behemoth Credit Suisse along the way. And all of this was provoking an aggressive policy response. So that was kind of the good news. We saw the cavalry ride in. There's now, I'd say, a de facto implied deposit guarantee in the bank sector, although it's not, formalized. And then we saw, massive liquidity facilities become, availed to U.S. banks, and together, with lower bond yields, that the lower bond yields were really created by the implied adverse economic effects of the bank crisis, of the fact that we're very likely to see a bank credit tightening in the wake of what just happened. But the good news is that allows those bond yields, which were rising in February, to begin to come back down. So it was kind of a round trip on bond yields. And that helped all of that, the stimulus or the liquidity facilities, implied deposit guarantees, lower bond yields began to restore order and stability to markets by quarter end. Unfortunately, international and EM, or at least unfortunately for our strategies, they did end up underperforming amid all that volatility through the quarter, but did finish positive on the quarter. And think it was kind of things were returning to normalcy by the beginning of the second quarter here. We see that underperformance of international and EM as a short-term phenomenon. For our strategies in particular, in terms of the first quarter performance, and I think Anuj is going to give some color in a bit, but all of our strategies delivered low single-digit gains. Our EM and New Asia strategies modestly underperformed their benchmarks, while the International Growth Fund underperformed by a more notable amount, and that was really driven by an unusual one-off event largely. So, kind of lots of twists and turns during the quarter, and, we kind of came out okay, and we're kind of looking cautiously optimistic from here.
Great, thanks, Michael. Probably more important, I think, for the audience would be your outlook. You were turning more optimistic towards EM and international assets in your year-end update. Has anything changed on that front?
No, not really. I think looking back, the global banking crisis that just played out, what that really does, as far as we're concerned, is it confirms that further central bank tightening would be a policy area. I mean, this recent banking crisis is the unintended and direct consequence of previous central bank behavior, both aggressive easing, staying too low for too long, in the wake of COVID, and then this past year of aggressive tightening, 300 basis point increase in real rates from, say, negative 125 basis points to positive 175. That is really a very substantial and abrupt repricing of credit on the short end. And we know, whether they want to admit it or not, central banks will prioritize financial stability in times of crisis. So, we now have seen the second time we start bumping up against this kind of high 4-5% level on the short end, or in terms of Fed hike expectations. And we see financial instability beginning to play out in significant fashion. So we think this confirms the premise we laid out at the end of last quarter, around year end, that we're passing through peak hawkishness, that a dollar bear market and an EM international equity relative bull market lies ahead. We kind of maintain that conviction. And I think in recent weeks, investors have been embracing these emergency liquidity measures, deposit guarantees, that's a bullish signal for equities, that essentially interpreting that the Fed cannot or will not trigger a debt deflation, taking tail risk off the table. But the crisis also suggests that we should see some bank credit tightening and a slowing economic growth. And I think all of that has helped drive, as I just said, market rates lower. That's the silver lining that's been supporting equity valuations and multiples, particularly in growth or technology sector, I would say. And so while we are breaking the fever of inflation and central bank tightening, the question is, how much and where will earnings begin to slow or retreat from here? We have entered this period of acute earnings vulnerability, as we've been saying. And I think another short-term challenge for equities is that we have already priced in a series of Fed rate cuts. And while that easing is probably what the Fed should do, we fear they may be too patient with the cuts. They do have a credibility problem. They're trying to restore their credibility, and this may deepen or prolong this heightened period of earnings vulnerability while they wait to see the whites of the eyes of disinflation. But we think that risk is more acute and more particularly directed at U.S. or global equities, because in contrast, China is now recovering and easing, and many international and EM jurisdictions that either began their rate hike cycle well ahead of the U.S. or have just have had a much lesser challenges with inflation. They are well positioned as we pass through peak hawkishness, because the Fed moving to a pause is more of a signal that they can begin to ease, because they've had to be much more aggressive in the face of weaker currencies, et cetera. That's been part of this sort of aggressive Fed tightening cycle. So with the tail risks of currency depreciation and inflation ebbing for those EM and international jurisdictions, and a bank credit tightening having already played out in a lot of those countries, or is much more advanced, to us this supports and suggests that our thesis of outperformance for these ex-US markets remains very much in place. Certainly in the near term, but more importantly over the longer term. And I think I should just comment on China and India specifically. Those are large parts of our exposure, large parts of EM. Market cap. China equities really began strong in the beginning of the year on enthusiasm over reopening and policy support. We talked about that at the end of last year. That enthusiasm began to peak out in late January, and China equities retraced most of their gains that they had kind of logged earlier this year. And we believe some conflicting or volatile economic and consumption signals should be expected given the abrupt end to zero COVID policies. It takes some time to restore consumer confidence, et cetera. But we are, remain encouraged on the margin that in the near term, we expect recovering growth and revenue environment this year, combined with the cost and capital discipline that's played out in recent quarters, that this will likely drive a material earnings outperformance against very subdued expectations. And so, we remain optimistic. I think further, the Alibaba restructuring announcement, breaking into 6 pieces, to us, that following on the heels of Tencent's, shareholder-friendly moves over the last, several months as well. These things don't happen without the express approval of regulators, of the government within China. And we think this is a signal that the government is supporting supports a re-engaging of the entrepreneurial spirit in China. We're seeing, a lot of these restructuring are pointing towards IPOs, local listings, and to us, our takeaway is that the government in China is saying that the tech and platform economy is now suitable for domestic retail investors. You're going to see a lot of listings and IPOs coming out in mainland and Hong Kong this year and into next year. To us, this is a very big deal. On India stood out during last quarter as one of the weaker equity markets, registering a modest decline and a solid, kind of amongst solid positive, gains for global equities. And while this did hit our relative performance across all of our strategies last quarter, we think the weakness is really, largely attributed to strong previous outperformance, but also due to allegations of aggressive practices by the Adani Enterprises Limited and related companies. And that happened just in front of a high profile and large equity offering. And so that created, further kind of indigestion for India equities during the quarter. But we just want to reiterate, and I'm sure Anuj will kind of elaborate, that, India really represents to us the most attractive long-term global investment jurisdiction. After mean reverting in the last 2 quarters, it's materially underperformed, or it's mean reverted back to its kind of median relative valuation. And so now from this point, given the growth visibility and the growth quality of growth has vastly improved in India, we're very enthusiastic regarding our many investments in that market. That's really all the kind of near and intermediate term. And I would say longer term, just want to reiterate also that international and EM, these markets are at 20, 30-year relative valuation lows, with, in our view, improving relative earnings growth that is, is likely to surprise and sustain. Especially given the very modest expectations that we think most investors and allocators have for EM and international at this point. What are the drivers of that sustained upside surprise in relative earnings? It's, one is the top in the US dollar bull market giving way to a dollar bear market that we expect. We've elaborated at length in the past on our, the fundamental drivers of that. 2 is the global CapEx cycle that's necessary to fund deglobalization and really restore energy, commodity, agriculture, defense security around the world. That spending will favor EM and international jurisdictions and markets, given that they are more heavily weighted towards those industrial real asset sectors. And 3rd is India's productivity miracle that's reaching escape velocity. We've talked a lot about that. And last is China's shift to value-added economic activity. I'm going to take a pause here, but we clearly remain optimistic and enthusiastic, and think that the valuations today really do not reflect the improving fundamentals.
Thanks, Michael. Anuj, could you walk us through a review of what worked or didn't work in the first quarter, and maybe some thoughts on new additions to the portfolio during the quarter?
Sure. Thanks, Roger. So I'll share a quick summary of 1Q performance for all our funds, and then I'll hand it over to Chingiz to talk about a couple of new ideas that we included in the portfolio that we're really excited about. So starting with the Barron Emerging Market strategy, as Michael mentioned, we modestly underperformed our primary benchmark, the MSCI EM index, while also modestly trailing our all-cap growth proxy. So from a theme or sector perspective, one of the biggest detractors this quarter was our stock selection in the financial sector. And this is mostly our investments in the India consumer finance and wealth management theme. Businesses such as Bajaj Finance, SBI Life, GM Financial, that have been long-term investments for us and that have worked reasonably well over the years, saw some underperformance this quarter. I would also add select investments in the energy space, namely Tenaris and Reliance Industries, also took away from relative performance. As a partial offset, we had pretty solid stock selection in the industrial sector, and this is being driven by some of our investments in our China value-added theme. And I would point out and highlight our investment in S2 Automation. That's China's leading robotics company that's gaining market share and is positioned to grow in excess of 25-30% for the next 3 to 5 years. So we are really excited about that investment. Lastly, we did not have any exposure to the utility space that underperformed as a sector. So that was also an offset as a contributor for us. From a country level perspective, I think Michael had mentioned about India. That was a key drag for us this quarter, and it was also a detractor last quarter. So it's been a tough 3 to 6 months from an India perspective. But what's really happening out there, and once again, Michael mentioned that, is we are seeing really a mean reversion of valuation multiples and more of a time-based correction after really stellar performance over the past 2 to 3 years. And despite this recent underperformance, India remains one of the best performing markets globally on a rolling 3-year basis, even trumping the returns for the S&P 500. So we remain really excited about our investments in India, and this is really being propelled by productivity enhancing economic reforms that have been implemented by the government over the past few years. And we've talked about these in length, but what this is really doing is it's positioning India for sustainable higher GDP growth while also accelerating the formalization and digitization of their economy. And so from a bottoms-up stock perspective, it's really creating pretty attractive opportunities for long-term investors such as ourselves. We would also add, besides India, we had weak stock selection in Korea and also had a lower weight in Korea that performed really well this quarter as a country. So that was also a key detractor for us. On the contribution front, China really stood out. It was our largest contributor, and we are encouraged with the recent performance and remain optimistic about a continued recovery as earnings outlook is beginning to improve as China's economy begins to reopen post the dismantling of the zero COVID policy. Another tailwind for us this quarter was a good stock selection and our underweight positioning in South Africa. That helped us as well. And our active exposure to Japan by our single investment in Keyence Corp. That's a leading global industrial automations, applications producer, and machine vision systems integrator. And we believe prospects for this business are pretty exciting. I would just add, I guess just moving on to the Barron International Growth Fund, as Michael mentioned, we underperformed our primary benchmark as well out there, the ACWI ex-US index, while also trailing our all-cap international growth proxy. One of the biggest detractors this quarter for us and accounted for almost 1/3 of the underperformance was related to a material adverse event relating to a company we own called Van Disco, wherein management disclosed in March certain fraudulent practices from a rogue senior salesperson in terms of big contract wins that clearly was not actual, was not true, and as a result of which stock trading was halted, and we had to take a approximately an 85% markdown to our investment there. But this is on the backdrop of almost a 200% rise in stock price over the past 6 months due to the excitement of these big wins. So while this is shocking news and we're disappointed, we've really not seen such an event play out in the past 12 to 15 years of running the strategy. So we do not anticipate such events happening in the future. So just moving to a sector, a theme perspective, I would say our relative underperformance was broad-based, but adverse stock selection in the industrial sector relating to some of our investments in the sustainability theme, as well as our Japan staffing theme, was a key detractor to relative performance this quarter. We would also add poor stock selection in the information technology space, and this is primarily due to our investment in Van Disco, also detracted from relative performance. We also had a few investments in the biotech and diagnostic space in the healthcare sector that did not perform as per expectation, and so that detracted from relative results. On the contribution front, we had good stock selection in the consumer discretionary space across various themes, companies such as eDreams, Inditex, B&M Value Retail all outperformed and did well. And so that contributed to relative results. And we would also add that we did not have any exposure to the utility space, similar to the EM strategy, that also helped performance. So just moving to a country level perspective, poor stock selection in the UK, once again led by our exposure to Van Disco, was a key detractor. We also had certain investments in France and Netherlands that took away from our performance. We'd also add negative allocation effect and adverse stock selection in countries such as Germany, India, and Brazil, also detracted from relative performance. On the contribution side, our overweight positioning and good stock selection in Spain stood out as a key contributor. And we would also add good stock selection in Japan, Switzerland, and China, also supported relative results. So just moving on to the Baron New Asia strategy, I'm not going to go into much detail here, given the performance trends were very similar to the EM strategy. So in light of time, I'm now going to hand it over to Chingiz to talk about a couple of new investments.
I just want to make one additional point, if I can, Anuj, that I observed, which is particularly the International Growth Fund, which has got more of that kind of small mid-cap complexion to it than the emerging market strategy. We saw in the aftermath of the global banking crisis that in markets like the U.S. and Europe particularly, where there's more concern around ongoing stress in the bank sector, that small mid-cap stocks began to they didn't bounce back at the late in the quarter the way large cap, mega cap did. And I observed some of that in that International Growth Fund. I mean, and I think that fund was tracking the benchmark indices through the end of February, and it was really in March, and when that the SVB event began to play out, that we started to notably lag. And I think that to the extent that liquidity concerns kind of normalize, we should expect some catch up for the smaller cap parts of the market on a relative basis.
That's a good point, Michael. So I'll now hand it over to Chingiz to talk about some of the new investments we've had. Chingiz?
Thank you, Anuj. I want to highlight two new investments this quarter as part of our sustainability theme. We've initiated 2 positions in the EV battery material space in Korea, Samsung SDI and LG Chem. So as you know, as a firm, we're very excited about bullish on the electric vehicles, energy storage space, and expect large-scale batteries demand to grow at more than 20% per year over the next decade. Now, we think these Korean cell makers are key beneficiaries of demand growth for EV and energy storage systems around the world. We followed these names for a long time, met management teams multiple times, and I even traveled to Korea recently as part of our due diligence process. And we now see more evidence of sustained higher pricing power, stronger returns, and market share gains as these players are best positioned, in our view, to gain from additional US and European policy support under the new legislation, such as the Inflation Reduction Act we've talked about last quarter. So Samsung SDI is one of the world's largest lithium-ion battery companies, cell makers based in Korea. It's a well-managed company with strong pricing power. It's one of the leaders in the development of high energy density performance batteries, including the next generation cylindrical batteries and solid state batteries. We see a step change in growth rates and market share gains in the US and Europe with investments in local EV battery plants, as it also benefits from domestic manufacturing policy support. Samsung SDI has one of the leading margins and return profiles among battery cell manufacturers, and yet it trades at a discount to its peers. They're very conservative when it comes to costs, focused on protecting their returns through long-term, multi-year supply agreements, where they pass on most of the commodities, metals, price increases, and other external risks to OEM customers. And they've had solid execution over time. Another investment I want to highlight is we made an investment in LG Chem, which is a parent company of LG Energy Solutions. It's the world's #1 EV ESS battery manufacturer outside of China. It also has a strong pricing power and a diversified global customer base with leading OEMs such as Tesla. Over the past few years, LG Chem has transitioned from being a petrochemical major to becoming a leading manufacturer of EV battery cells and advanced battery material components. LG Chem is a key supplier to LGES of mission-critical battery materials, primarily high-energy density cathodes. And both of these companies are major investors in the US battery cell and cathode manufacturing and are also major policy beneficiaries. Now, LG Chem as a company trades at a meaningful discount to the sum of its parts, and its 82% stake in LGES alone is worth nearly twice the current market cap of the company. So aside from the narrowing holdco discount and growth in the value of LGES, we also see a significant upside from strong growth and high margins in the advanced battery materials segment. We expect the LG Chem's cathodes market share to grow over time due to further vertical integration within captive LG supply chain, as well as third-party order wins. And finally, the petrochemical segment should be less of an earnings detractor to the company going forward, in our view. Thank you, and now I'll pass it back to Roger for closing comments.
Thanks, Chingis. We did have a couple of questions come in on the Zoom. How do you see a prolonged Ukraine war affecting international performance, particularly if they're not lucky with the warm weather like in the past year? As well, can you talk about China's alliance with Russia during the invasion in Ukraine and how this will affect investing in China?
Sure. I guess really almost two separate questions there, so I'll kind of do them serially. You know, a prolonged Ukraine war, how does that affect international performance? I would say that is now the base case that's priced in the market. So I would say most people are anticipating a prolonged war of some sort. I don't think anybody's anticipating a near-term resolution and any kind of further change to the status quo right now. So I would say there's more likely substantial upside for international markets if we did see a nearer-term resolution, or perhaps China trying to bring parties to the table. Lots of people would love some form of resolution. The devil is in the details, of course. But so I don't see a substantial adverse performance. I see more upside. I think there was a part of that question, asking about energy dependence on Russia. I think when it comes to energy dependence, I think it certainly highlights the need for greater, investment around the world to restore energy independence. That's part of our, global security theme. We think there will be a lot of spending. But what we've seen since the invasion last year is just in the near term is a shift in the pattern of where energy, oil, carbon flows. What countries sell to who. Western countries are not buying Russian energy per se, or they're certainly buying substantially less of it, and certainly like India and China and others are benefiting by the redirect of those flows. They're able to purchase at a discount. But we don't really see, while there was lots of concern about the near-term effect on Europe, yes, they were kind of helped by a warmer winter, but at the same time, we don't think there was a total embargo and a massive increase. Really, energy prices peaked right in the aftermath of the invasion. So that's telling you that we believe, Europe will be able to manage, even if this was extended and we'd had normalized weather patterns. China's alliance with Russia, that was established before. It had been in the works long before Russia's invasion. China was certainly surprised and disappointed, at the, with what happened kind of soon after some public comments that they made about their alliance with Russia. Their alliance with Russia is kind of economic and geopolitical. They need a source of commodity. They want, the traditional export channels are beginning to shift and change, and they see Russia as a large market that can become a source of demand for products that might be increasingly diverted away from U.S. or Europe and perhaps towards Russia. And so, we don't see the Russia-Ukraine conflict per se. In fact, I would say markets are more concerned and reticent than what we think is reality when you think about China's involvement with Russia, particularly with regard to say Ukraine. China has actually, and I think there was news today that came out today about the Wagner Group back in February. There was some news, some noise that came out, rumors that concerns out of U.S. national intelligence that they were concerned that maybe China was going to, begin supplying some sort of lethal aid to Russia. It turns out today there's news out that it was the source of that was Wagner Group requests for aid from China, which China rejected. And there's news out today from U.S. national intelligence saying that that China did. They're confirming that China did reject the idea of providing direct support to Russia and Wagner Group. So we think that's, there's been nothing but, a year plus worth of evidence that shows that China is showing restraint and discipline and not willing to directly engage and support Russia's, war, campaign, invasion of Ukraine. They are supportive of Russia in general. They do want this they like the fact that Russia is kind of supporting the notion of China's RMB being held out as a potential reserve currency. There's an alliance forming between Russia, the Middle East, and China from a kind of global trade commodity flow perspective, which is kind of furthering the notion that the RMB can stand as an alternative to the dollar for countries that they are actively trading with. And frankly, I know there are questions about China's intent regarding Taiwan. China invading Taiwan would go directly against the idea of what they've been trying to create over the last 20 years and the progress they've made. And certainly with regard to holding out their currency as a potential reserve currency, that would be just substantially undermined were they to invade Taiwan in the near term. So, for all of those reasons, we kind of think that that the market has taken a very bearish view of, both Europe or international exposure to, disruption from Ukraine, Russia war, and also a negative view of China with regard to their alliance with Russia. And I would say that's pretty fully baked into market discounts multiples. There's probably more upside than downside given the likely probabilities of what plays out from here.
Great, thanks, Michael. Anuj, when you were talking about, you mentioned relative valuations are high. What are your thoughts about selling out of some of India, reducing exposure there, and then rebuying at generally better relative valuations?
Yeah, thanks, Roger. So I would make a couple of points out here. Number one, we are long-term investors. We are not trying to play one quarter over another in terms of relative valuations for one country over another. And we're really looking at an opportunity set that spans 3, 5, 10 years. So from that standpoint, we try and limit our churn and focus on businesses for the long run. So that I would say that's one point. And the second point is, we did acknowledge that valuations were overextended. And so we did take a little bit profit from our India investments and reallocate it elsewhere. So, we were cognizant of, extended valuations. We did trim a little bit of the portfolio, but we are not going to make any outsized reallocations just because of near-term valuations. So I would say that's how we were thinking about it.
Great.
Yeah, I think we moved to 300 basis points or something, which is like maybe 10% of our total exposure. So you do a little something, but as Anuj says, we're not going to do a wholesale, a wholesale scaling back of our commitment to India because it looks particularly rich on a 6-month basis. Yeah. And Ching has mentioned, those two names in the Korea EV space, that was funded by raising that marginal capital from trimming India.
And also raise just one interesting point. If you actually look at the earnings projections for many of our businesses in India, they've actually been upgraded this year, while a lot of businesses in Korea and Taiwan are being downgraded. So you're really seeing a little bit of a reversion of multiples in Korea, Taiwan from really depressed levels coming back up, and India kind of moving on a kind of time-based consolidation. So fundamentals, earnings, that's what we focus on, durability of earnings growth. Those all remain intact and improving in India.
Great. Well, thank you, Michael. Thanks, Anuj. Thanks, Chinggis. This concludes today's call. If we were unable to get to your question, please reach out to your Barron salesperson and they can help answer it. A recording of today's event will be available on our website, www.barronfunds.com. Again, I want to thank Michael and Anuj for their comments, as well as all of you for joining today. Most importantly, I want to thank you for all of your support of the Barron Fund family. Thank you.